we've got to get over now to Larry Shover, Chief Investment Officer at SFG Alternatives, who joins us from Chicago. Larry, great to see you there. Thanks so much for your time. Let's get your take on the Fed. We'll be hearing from them a little later on, or in your time tomorrow. What are you expecting?
Well, I'm not expecting a whole lot with regards to policy change. I think we're actually hoping, and the markets are leaning on some type of vernacular change. Maybe an acknowledgement that our labor market is suffering still. Our output gap is much too large. It's going to be very interesting to see if they talk about inflation at all. Keep in mind, in the United States, core inflation right now is the lowest level it's been since January of 2011. And lastly, I don't think this will happen, but people are hoping there might be some type of talks about what's going to happen going forward. Is their policy going to be a no-sale policy, meaning they'll turn into coupon clippers, not selling any of their holdings, but letting their balance sheet run off course like everybody else does?
Larry, Matt Johnson here from UBS. Look, at what point will the Fed expand their balance sheet further? You said before that demand sounds like it's slowing down in the US and that inflation's running very low. Is there a point at which you think the Fed would actually ease policy further?
Yeah, I mean, I think if the labor market continues the way it is, I mean, there is a chance that they would, but I don't think that's going to happen tomorrow. I mean, they have a way of perhaps surprising all of us, but right now, I mean, I think it's going to perhaps take maybe three or four bad BLS reports that we're going to see Friday in the U.S. So keep in mind, I know you know this, but we're penciling in like 150 to 155,000 job ads. This comes off of 88,000 the months before. So if we see 2, 3, or 4 of those in a row, I think they'll have to do something, or they will do something.
Yeah, that's interesting. So this means adding to that $85 billion. I mean, what kind of numbers, I know that this is just pulling them out of the air, but what kind of numbers do you think we could actually see if these data prints come out worse than expected? How much money could the Fed print?
They could keep continuing to do it because it seems like this is a policy experiment. Nobody's had a balance sheet, as far as I know, that's $3.2, $3.4 trillion and knows how to manage it. So we're in, Kate, we're in uncharted waters. So they could definitely expand it. They could go out the curve a little bit more with mortgage-backed securities. They definitely could do more. They have a lot more options. It's just the effect they get for those options and the costs that they incur for doing those options.
Okay, what's the feeling down there at the CME Group as to when you'll see quantitative easing? And once again, I know it's a really tricky question, but this is what the market's wondering right now.
Yeah, it is, and I think that's why we're seeing these slow and choppy grinds in the market that we're seeing. I mean, right now, I think people are just so dulled and so numb to it all, and the numbers are so big. I do believe that people think this is going to last a lot longer than most of us expect. I mean, I think, the smart traders out there realize that this is a policy experiment, and it's going to take a long time for our labor market to heal, so it's probably going to persist much longer than most people give it credit for. Okay,
so how are you building your trading strategy around that, Larry?
Well, for me, it's been troubling because, I'm in alternative assets. I rely on divergence, and that's alpha with, CTA investing and allocating to commodities across all sectors, FX, et cetera. If I was looking just at quantitative easing, I guess I would continue to go out the financial repression curve and continue to buy equities. That seems to be the thing that's working right now.
Okay, let's talk gold as well, because hasn't been a great place to be recently. You'd think it would be with all this talk surrounding QE. So what's your outlook there?
Well, I still think that gold's part of everybody's portfolio to what we've talked about for the past 3, 4, 6, 8, 20 weeks. And that's, we just don't know how this all is going to end up. I don't buy gold. I don't think we should have gold as an inflation hedge, because I do believe there's better ways to hedge inflation than with gold. But the fact that we have 3 or 4 central banks around the world doing what they're doing right now, I think it makes a lot of sense to have more than you typically would want to have of gold exposure in your portfolio.
Okay, we've also got the ECB meeting. We'll hear from them on Thursday, Larry. What are your expectations here, and does it matter in terms of what you buy and sell over there?
Yeah, that's a good point, because it's funny. In Europe, all the analysts and traders I speak to, they're very focused on the fact that the ECB is going to cut rates. Here on stateside, it seems it's just the opposite. But the bottom line is, it doesn't matter if they cut rates. I mean, I think we have to worry a lot more about the noise and the anti-austerity noise that we've been hearing lately. The fact that people are saying that Merkel, all she cares about is the German savers, and the fact that Cyprus did not cause a contagion atmosphere. Spain needs 2 more years. Those are things that Draghi is going to have to deal with, and cutting rates really isn't going to do a whole lot of anything, especially because the monetary policy transmission mechanism has not worked yet.
Okay, Larry, I wanted to get to Japan, but we don't have time. We'll have to chat to you next time. Thanks again.